Is a 1.25% rate cut coming sooner than we think? And what now after last week's market meltdown? Hello, members, super savers, and bond course fans. I hope you're having a good week, despite the very bad week that the markets have had. It was a real bond bloodbath, and the equity markets didn't fare better either. Here are the 3 topics that we'll be covering in this week's update video. 1. Why did everything collapse this week? 2. Which treasuries have fallen below 4%? And what now for bond investors? And 3. What's on the upcoming Treasury auction schedule? And what are the highest yielding new issue agencies, corporates, and brokered CDs currently? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Where do I even begin? What a difference a week makes. As some of you may recall from last week's update video, at that point in time, the market had predicted about an 88% chance of a 25 basis point rate cut at the September FOMC meeting, and about a 12% chance of a 50 basis point rate cut from our current range of 5.25% to 5.5%. Here's where things stand now, 1 week later for the September FOMC meeting. The probability of a 25 basis point rate cut has gone down to 31% from last week's 88%. And the probability of a 50 basis point rate cut has gone up to 69% from 12%. In other words, the market now expects drastic action from the Fed at their next meeting. And according to Bloomberg this past Friday, Citigroup economists said they expect half-point rate cuts in September and November and a quarter-point cut in December. That's a 1.25% cut by the end of 2024. No surprise given this week's events. First, Fed Chair Jerome Powell himself floated the possibility of a first rate cut in September if data holds up. Second, unemployment claims were close to a 1-year high, while manufacturing activity slumped to an 8-month low. Third, the latest jobs report showed that hiring in July slowed significantly, with the unemployment rate rising to an almost 3-year high. And fourth, equity markets all over the globe ended the week steeply down. The tech-heavy NASDAQ is now officially in correction territory because it's down more than 10% from the last peak that it reached just a few weeks ago in mid-July. The widely traded S&P 500 was down significantly as well, while the more small company-focused Russell 2000 index is not quite in official correction territory yet, but was getting close this week as well. Now, for much of this year, equity markets have been going up and up in hopes of a soft landing, meaning the possibility that the U.S. economy could avoid a recession despite the Feds having kept the rates high now for quite a while to combat inflation. But the global sell-off in stocks that we were witnessing this week seems to indicate otherwise, and the possibility of a recession in the U.S. is now being taken seriously again by many market participants. As we sometimes see in crisis-like times, though, one asset class's pains can be another asset class's gains, because where do investors instinctively turn to when the markets get a bit wobbly? They buy the safest and most liquid asset there is on this planet and bring their money into the safe haven of U.S. Treasuries. And yes, once again, we could observe the classical flight to safety reaction this week as investors were shifting into U.S. Treasuries, bringing us now to the next section of this video. Now, as investors flock into U.S. Treasuries as a safe haven, they drive up the prices of U.S. bonds, which also means lower returns. Remember, the mantra in bond land, prices up, yields down. And of course, this is generally good news for existing bondholders whose bonds are going up in price, producing a gain at least on paper, but bad news for all those who are looking to buy new bonds, as these will now be more expensive, but carry a lower yield. So, as we so often do at the end of a week, and especially after a week like this one, let's see where we stand and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Now, as a bit of a surprise, the 1-month T-bill even went up by a few basis points. But this was the single exception in the Treasury maturity range. All other yields were down a lot, as expected given what we just talked about in the previous section of this video. The 2-year, 3-year, 5-year, 7-year, and 10-year even fell below 4%. Even worse though, basically all the yield gains on Treasuries for this year have now been wiped out, as we can see in this comparison of Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Except for the 30-year, which is pretty much break even from where it started on January 2nd. This was the first week in 2024 where yields across all these other maturities ended lower than they did on January 2nd, and sometimes even significantly so, like here for the 1-year and the 2-year. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. Do note that this rates overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what is shown here. Looking at this year-to-date yield comparison, I'm guessing some of you who've been dollar cost averaging into longer dated bonds since we started talking about this last year, you might be feeling a bit smug right now. But where do we go from here, right? Well, when we posted this poll on Friday asking what you're doing with your fixed income portfolio on the long end, given that bond yields are all down, the answers were all across the board. About a quarter of you are continuing to dollar cost average into longer dated bonds. And a bit more than a quarter of you fall into these two categories on the opposite end of the spectrum. You're either buying even more long bonds now because you think rates have peaked, or you're still waiting for rates to go higher on the long end. Those of you in the other category mentioned I bonds, CDs, annuities, and various ETFs. As our Diamond NestEgg regulars know, and as I've said often on this channel, no one can time the market, not even the Fed. Had Fed officials anticipated what Friday's jobs report would show, they may have come to a different decision about holding rates stable. And who knows, right? Even though all the headlines are screaming crisis and collapse right now, maybe we're just witnessing a temporary summer tantrum in the market that will pass as quickly as an August thunderstorm, as at least this investor here seems to believe. August is a horrible, horrible month for the stock market. And the reason I know that is it has interrupted almost every one of my summer vacations over the past 20 years. And he's right. I always bring my YouTube recording gear with me on our August summer vacations because I've almost always had to tape on every single one of them. I think last year's August summer vacation video was about Fitch's downgrade of US debt. In any case, let's see. Things could all get much worse before they get better again. We all may have our assumptions and scenarios, but no one really knows. I've said it before and I'll say it again. If I were in my 60s or 70s, I would be in this group here and continue to spread my risk by dollar cost averaging into treasuries and other bonds I'm comfortable with. And if you're in your 60s, 70s, nearing retirement, or already in retirement, here's a friendly reminder that despite the recent bond bloodbath, rates are still higher now overall than they have been for a long time. On this chart, you can see the yields for the 3-year, the 10-year, and the 30-year Treasuries over the past 10 years. And if you're wondering why I chose these maturities, it's because these are the maturities that the Treasury will be auctioning off in the coming week. This red line shows the yields on the 3-year T-note. The blue line shows the yields on the 10-year T-note. And the yellow line shows the yields on the 30-year T-bond. And yes, these yields are still substantially higher than they were just a few years ago. For those of you in Bond Masters, please refer back to Module 3 here for the videos on dollar cost averaging into Treasuries and other bond strategies that you may want to consider as the rate environment evolves. And don't forget, you can mix and match bonds and bond-like investments within your ladders and your overall portfolio. For example, I know some of our YouTube Super Saver members and bond course folks have recently started adding annuities to their investment mix and are quite happy with their decision. Depending on the type of annuity we're talking about and which state you live in, there are opportunities to get yields above 5%. Annuities are bond-like, but they are not bonds. So if this is something that you want to learn more about, do drop a comment below and let us know. Of course, the other option if you're dollar cost averaging is to consider agencies, corporates, and brokered CDs, or to simply skip a Treasury auction if you're really not feeling good about it. So with that in mind, let's move on now to the next section of this video. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. The 52-week T-bill will also be auctioned off on August 6th. And if we scroll down further, we can see the 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon still remains to be determined on auction day. At the time of this taping, here's what the coupon and the expected yield are for the 3-year T-note auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. For those of you interested in agency and corporate bonds for a bit of a higher yield, here's where the highest yielding new issue agency bonds stand at the time of this taping on Fidelity's platform. Here's where the highest yielding new issue corporate bonds stand at the moment. And here's where the highest yielding new issue brokered CDs are currently. And if you want to learn about the safest, easiest, and fastest ways to get started with bond investing and building out your bond portfolio, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A on August 21st at 6 p.m. Eastern Time, 3 p.m. Pacific Time to continue the discussions further on all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. All right, members, Super Savers, and bond course fans, I hope you enjoyed this video and learned something new. Good luck to everyone who's planning on picking up some bonds and CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.